Hello, welcome back to class. We'll be talking about petroleum profit tax in Nigeria. Petroleum profit tax in Nigeria, and we'll quickly look at the scope and application, determination of assessable and chargeable profits, allowable and disallowable expenses in oil operation, the capital allowance computation under the PPTA, and filing assessment and payment procedures. And looking at the definition, PPT is actually the specialized tax on profits from upstream petroleum operation, which include the exploration, drilling, production, and sales of crude oil. And the governing law for this is actually the Petroleum Profit Tax Act, CAP P13 LFN 2004 as amended. And why do we have to prepare a separate tax for this, since it's actually still a complaint which they might possibly charge the company income tax? The reason is because it captures the unique high risk, high reward nature of the oil sector. Also, it's one of the highest revenue generators for the federal government. And lastly, it is distinct from company income tax, which applies to other sectors. And the core principle is the ring fencing, and this deals with petroleum profits must be computed separately from non-petroleum profits. And the scope of this is, and the application is the upstream operation under the oil prospecting license and oil mining licenses, the joint venture, the production sharing contract, marginal field operation. And the key differentiator is actually that the PPTA tax the activity, which is the petroleum operation, and not just the entity. It tax their activities also. And we have a varying arrangement for the tax rate in terms of joint venture having 85%, production sharing contract having 50%, and new company tax rate for petroleum profit tax under certain conditions at 65.75%. Looking at the expenses, when we talk about the expenses, the golden rule for expenses deductibility is under the Section 10 of the Petroleum Profit Tax Act. And to make an expenses allowable, it actually must be incurred wholly, exclusively, and necessarily, and it's in the course of petroleum operations. And when we talk about the allowable expenses, they are the field operation costs, the royalty and rent to government, staff costs, specific bad debt, repairs and maintenance, and the likes. And for the allowable expenses, which should be added back, they are the depreciation, the fines and penalties, the general provisions and donations, excess head office charges, non-petroleum expenses. These are the disallowable expenses. And in calculating this, we have to note the assessable profit. And this is actually to adjust the accounting profit to reflect the rule of PPTA. And to do this, it is accounting profit plus disallowable expenses and minus allowable expenses. And we have an example here where we have the accounting profit and the disallowable expenses are to be added back and the allowable expenses are to be deducted. And we have from a profit of 1.2 billion, the accessible profit now becomes 780 million. And under the capital allowance, the PPTA, in treating capital allowance, it's actually tax deduction for wear and tear on qualifying capital expenses. That is for capital allowance. It's a tax deduction for wear and tear on qualifying capital expenditures, and it replaces accounting depreciation. And the key feature is no initial allowance, unlike the CIT, and the annual allowance is 20% of the QCE. And we also have the uplift allowance, which talks about an addition of 20% to the unclaimed balances, especially in the PSC. And the illustration of this, is shown where we have the QCE having 800 million. We have the total annual tax. To calculate the total annual tax, it is 20% of the 800 million, and we have 160 million. And for uplift allowance, we have 20% of 800 million minus 160, which gives 128,000 naira. And for the total capital allowance, we have 160 million plus 128 million, which is 288 million naira. In computing the chargeable profit after the assessable profit, in computing the taxable chargeable profit after the capital allowance, we need to note that chargeable profit is the final taxable profit, and to do this, it is assessable profit minus capital allowance as it has been calculated or as shown in the previous slide. And the 15% restriction rule is stated where capital allowance cannot reduce chargeable profit below 15% of assessable profit. Also, government minimum revenue assurance. The rule states government minimum revenue assurance. And an illustration of this is assessable profit of 780 million and a minimum chargeable profit of 15 million multiplied by the 780 million, which gives 117 million. And the tentative chargeable profit is 780 million minus 288 million, as it has been calculated in this place where we got the 288 million, and that gives us 492 million. And you need to check, is 492 million greater than 1 or equal to 117 million? And that is yes. Therefore, full capital allowance is claimed, and the final chargeable profit is actually 492 million naira. And the final PPT liability and compliance procedure. The PPT calculation is actually chargeable. The profits, the petroleum profit tax is equal to the chargeable profit multiplied by the applicable tax rate. And for example of joint venture, an example of joint venture, as the rate has been given, which is 85%. So 85% of 492 million is actually 418.2 million. 418.2 million, and that is the petroleum profit tax. And for the key compliance deadline, we have the estimated return. The estimated return, which is filed within first 2 months of the accounting period, the final return, which is filed within 5 months after the year end, and we have the payment, which is monthly installment, final balance due within 1 month of filing, and penalties for non-compliance, late filing of return, which is 10 million plus 2 million per subsequent month, late payment of tax, which is 10% penalty plus interest at the central bank monetary policy rate, and we have the best of judgment assessment, where the FIRS can estimate the profit if return are not filed or are incorrect. In conclusion, PPT is a complex high-stake tax for upstream oil and gas sector, and ring fencing is critical. Keep petroleum and non-petroleum accounts separate, and you need to master the when test as a wholly, exclusively, and necessarily aspect. You need to note it to correctly classify expenses. And the 15% restriction rule on chargeable profit is a key difference from CIT, and compliance is non-negotiable. Strict deadline and several penalties are applied. So having a mastery of PPT is essential for anyone involved in the Nigerian oil and gas industry. Thank you.